In the intricate world of national economies, governments often find themselves walking a tightrope, balancing revenue generation with essential expenditures. When expenditure surpasses revenue, governments turn to borrowing, incurring what is known as public debt. This debt represents the total amount of money a government owes to individuals, institutions, and other countries. Effective debt management strives for a delicate equilibrium, financing development without imposing an undue burden on future generations. Debt, however, is not inherently detrimental. When channeled effectively, it can be a potent tool for economic growth and development. Public investment in infrastructure, education, and healthcare can stimulate economic activity, leading to increased productivity and revenue generation in the long run. However, excessive or poorly managed debt can have dire consequences. High debt levels can lead to soaring interest payments, crowding out essential public spending and hindering economic growth. The management of public debt is a subject that has long intrigued economists, giving rise to a plethora of theories and perspectives. Classical economists, such as David Ricardo, posited the idea of Ricardian equivalence. This theory argues that individuals, anticipating future tax hikes to repay debt, will increase their savings, effectively neutralizing the stimulative effect of government spending. Conversely, Keynesian economics, spearheaded by John Maynard Keynes, posits that government borrowing, particularly during economic downturns, can stimulate demand and revitalize stagnant economies. Keynes argued that governments should actively manage their spending and borrowing to mitigate economic fluctuations, even if it entails incurring debt in the short term. Buchanan's view on public debt, rooted in public choice theory, introduces a more skeptical perspective, arguing that politicians might engage in excessive borrowing to appease voters, even if it leads to long-term economic instability. Public debt is not a monolithic entity. It can be classified in various ways, each providing unique insights into a nation's fiscal position. One fundamental distinction is between internal debt, owed to entities within the country, and external debt, owed to foreign creditors. While both impact a nation's fiscal health, external debt often carries additional risks, such as exchange rate fluctuations and potential pressure from international creditors. Another crucial categorization is between productive and unproductive debt. Productive debt is incurred for investments expected to generate future income streams, such as infrastructure projects or investments in education and healthcare. Unproductive debt refers to borrowing used for consumption or expenditures that do not yield future income. Understanding these different categorizations of public debt is crucial for policymakers to assess the composition of the debt portfolio and formulate targeted strategies for effective debt management. Evaluating the sustainability of a nation's public debt involves scrutinizing key economic indicators. One of the most widely used indicators is the debt-to-GDP ratio, which expresses a country's gross public debt as a percentage of its gross domestic product, or GDP. A high debt-to-GDP ratio can be a cause for concern, as it suggests that a significant portion of the country's income is being used to service its debt, potentially hindering future economic growth. Conversely, a low ratio indicates a healthier fiscal position, suggesting that the government can comfortably manage its debt obligations. Another important metric is the fiscal deficit, which reflects the difference between government revenue and expenditure in a given year. While temporary deficits might be necessary to stimulate the economy during recessions, chronic deficits can raise concerns about debt sustainability. Other indicators, such as the interest burden, interest payments as a percentage of revenue, and the maturity structure of debt, also provide valuable information about debt sustainability. Managing public debt is not merely about minimizing borrowing. It's about strategic maneuvering to ensure that debt levels remain sustainable while supporting economic growth. One common strategy is debt diversification, which involves spreading borrowing across various sources and instruments. This helps mitigate risks associated with relying too heavily on a single source of funding and can secure more favorable borrowing terms. Governments also engage in debt restructuring, which involves modifying the terms of existing loans to reduce the debt burden. Monetary policy coordination plays a crucial role in managing the impact of debt on the economy. Central banks can adjust interest rates and manage liquidity in the financial system to influence borrowing costs for the government. Other strategies include enacting fiscal reforms to enhance revenue collection and rationalize expenditures, promoting economic growth to increase the GDP denominator in the debt-to-GDP ratio, and enhancing transparency and accountability in debt management practices to foster investor confidence. India, like many developing economies, has walked a challenging path in managing its public debt. The country inherited a substantial debt burden at the time of independence, and subsequent decades witnessed periods of both fiscal prudence and expansionary borrowing. In recent years, India has made significant strides in strengthening its debt management framework. One of the key pillars of India's approach has been fiscal consolidation, aiming to reduce the fiscal deficit and control the growth of public debt. The government has implemented measures to enhance tax revenue collection, rationalize subsidies, and prioritize capital expenditure on infrastructure and development projects. Furthermore, India has focused on developing a robust domestic debt market to reduce reliance on external borrowing and mitigate exchange rate risks. Despite these efforts, India continues to face challenges in managing its debt, with a relatively high debt-to-GDP ratio compared to other emerging economies. Public debt management is not a one-size-fits-all endeavor. It requires a nuanced understanding of a country's unique economic circumstances, institutional capacity, and long-term development goals. While debt can be a potent tool for financing growth and development, it's crucial to ensure that borrowing remains sustainable and does not jeopardize future generations' economic well-being. As India continues its journey towards becoming a global economic powerhouse, prudent and proactive debt management will play a pivotal role in ensuring macroeconomic stability, fostering investor confidence, and securing a fiscally sustainable future for generations to come.